Now, before we move on to the Q&A section, here are few common audit questions we often encounter. Say, for example, what are the reasons for the significant jump in the OCI? Say during FY 23-24, the OCI amount was say 1 CR. In the current year, say it has jumped to 1.5 CR loss. Now we cannot compare directly that one has become 1.5. We need to look at the individual items. So why was that one arrived? What was the reason behind that 1 crore experience loss or 1 crore OCI loss was arising in the previous year, and compare that with the reasons which we are encountering in the current valuation. So a significant movement in the OCI is typically due to any significant changes in the assumption that might have occurred during the valuation period, or any major data corrections or any policy corrections. The second is, can we consider previous discounted assumption for the current valuation? As obviously everybody should must be knowing that no, the discount rate assumption, and for that matter all the assumptions, all the data input itself, should be based on the current valuation date. So the discount rate assumption should be based on the government bond yield as on the current valuation date. Now, how do we recognize the impact of change in assumption? This we have covered in the previous slides. That I'll just reiterate that under Ind AS 19, the impact is recognized directly in the other comprehensive income. In AS 15, it becomes part of your expense itself. The fourth one is, what is the relationship between the actual liability and accrued liability? Now, accrued liability reflects the benefit earned till date, while the actual liability also considers the time value of the money and future salary projections. So this wraps up our discussion on actual gains and losses, and the floor is open for the Q&A. Feel free to drop your questions in the chat. I'll happy to answer them. I have couple of questions ready. Is it available to set up a fruit? So there is one question Mr. Has asked: is it advisable to set up approved gratuity fund in case of increasing liability on account of discount rate going down? And is there any estimation of discount rate as of March 26? Okay, so I'll answer the first part and then second. The gratuity to creation of the gratuity fund is not necessary per se. The act says it is not mandatory for any company to hold the fund. So even if the assumptions are going say against the company, say there is a drastic fall in the say discount rate assumption, the liabilities are increasing, it not necessarily mean that the company should fund more, because in next year, or it is not mandatory for the company to fund more. They can fund it to the extent of expected contribution. Say what is my next year income statement hit maybe, so basis that they can do it. Can you clarify the next part is, can you clarify actual and accrued liability? Now the actual liability, it is the present value of obligation of the future expected cash flows. So for example, if I'm standing at age 30 years and my retirement age is say 60 years, so my future cash flows will be for the next 30 years, right? So every year I'll prepare certain cash flows. What is my expected cash flow, say, and in case of death, in case of attrition, in case of retirement. Discounting those cash flows to the current date will give me a present value of obligation. And mind you, this expected cash flows will also reflect the increased salaries. However, the accrued liability is nothing but a simple calculation: 15 by 26 into salary into completed years. That is just a worst case scenario, that if all the liabilities were to settle immediately, what would be the impact on the liability? So that is what would be my payout. So that refers to the accrued liability. So in generally we show it in our report, we provide a separate disclosure for this discontinuance liability versus the actual liability, which gives us a reason behind why there is a jump in the ratio between them, why my liability is shooting significantly. So I'll give you a brief example. For example, my discontinuous or my accrued liability has increased by say 10%. This reflects that my overall data set has increased by 10%. There is no actual component in it, there is no assumption in it, it is just a simple mathematical calculation. So we would, in ideal scenario, expect my actual liability, my present value of obligation, should also increase by 10%. If it is increasing by more than 10% or degree, or say it is only increasing by say 5%, then there should be proper reason behind it ki why my liability is not increasing or why it is significantly increasing. Those probably are answered by any assumption changes or any data correction. So I hope that that clears your actual versus accrued. There's many companies obtain gratuity liability valuation certificate from LIC itself. So there is a question that many companies obtain gratuity liability valuation certificate from LIC itself, which has PVDBO, etc. Is that so? No. So as per the requirement, as per the regulatory requirement, you need to get the actual valuation certificate. The certificate that the LIC provides you, that is not considered as an actual valuation certificate. So you need to obtain a report from the third party valuer, which can be your actuary. While calculating there's a question that while calculating the attrition rate and gratuity, do we consider cessation of liability in case of employees leave before 5 years, and is there as there is no liability in this case? Okay, so in case, what we need to do is, in case for an employee who has a service year less than 5 years, case of gratuity, the payout will be done in if an employee dies. So when we do the actual valuation for the expected cash flows for until he achieve 5 year mark, it will be the death benefit will be determined. Post 5 year mark, attrition, death, and attrition and death will be determined, and on the retirement date, the retirement benefit will also be included. So yes, the valuation is required, but the actual valuation takes into the account that even if the employee leave before 5, there won't be any payout. However, in case an employee dies, there will be certain payout. So as we are running out of time, we have noted down all the rest of the questions and all of these questions, and we'll share with you all the answers along with the PPT within the next couple of days. I hope you like the webinar. Thank you everyone for trusting the team KPAC with your valuable time. Thank you
Thank
everyone.
you so much, everyone.